What if I told you a company could grow its revenue by over 112% year over year, hit a 4-year high in profit margins, and still have its stock price completely trapped, like a fly in amber, unable to move? Would you call that a breakout waiting to happen, or would you call it a perfectly engineered trap? Welcome back to Smart Stock Sam, the channel where we do not guess, we dissect, we decode, and we trade the data. I'm Sam, and today we are going all in on NIO, the Chinese electric vehicle giant that just delivered one of the most confusing yet fascinating earnings setups of 2026. Here is what we are going to cover today, because this is not a surface-level stock tip. We are going to rip apart NIO's financials layer by layer, analyze a brutal post-earnings price swing that told us everything about who is in control, decode what the smartest institutional money on the planet is actually doing right now, and then I am going to hand you a complete step-by-step trade blueprint for the week of June 1st through the 5th. And woven through all of this, there is one hidden metric sitting inside the options chain, a number most retail investors never even look at, that completely changes your risk calculus. Stay with me, because by the end of this video, you are going to see this stock in a way you never have before. Let me tell you why NIO is the most important Chinese EV story you are not paying enough attention to right now. The Chinese electric vehicle sector is an absolute war zone. We are talking about coordinated price slashing, margin destruction, and brutal week-to-week competition where the weakest players go bankrupt and the strongest are still bleeding. But inside that chaos, something genuinely extraordinary is happening inside NIO's balance sheet. And when the market misreads a company of this complexity, that is exactly where the opportunity lives. So let's map this out. When we analyze a volatile stock like NIO, we need a clean framework. 3 distinct forces pulling this price in 3 different directions simultaneously. The first force is fundamental momentum. This is the cold, hard financial data, explosive top-line revenue growth, expanding gross margins, and a hyper-aggressive new product cycle anchored by 2 incredibly important model launches. The second force is market sentiment. Do not underestimate how ugly this gets. We are in a volatile transition phase where the fear of Chinese EV price wars is colliding head-on with some genuinely powerful institutional positioning. These 2 forces are arm wrestling every single day. And the third force, the one that will define exactly what happens this week, is the trade setup. We are going to build a high-conviction thesis around a very specific confluence of technical support levels and the most revealing options flow data I have seen on this stock in months. Now, could NIO completely break every pattern we are about to analyze and do something totally unexpected? Could the stock just absolutely ignore its own options chain and blast straight through every resistance level by Friday? Technically, yes, but with the setup we are about to break down, the probability of that is about as likely as finding a parking spot in Shanghai at rush hour. Let's look at the price action. If you want to see exactly what institutional fear and retail greed look like colliding in real time, the post-earnings chart is the textbook. Following the Q1 2026 earnings release, NIO got absolutely punished, a vicious 7% post-earnings drop that sent the stock plummeting down to the $5.20 level. Why did the market react so harshly? Because Wall Street saw a 33.1% sequential drop in deliveries and heard management issue cautious forward guidance about rising material costs. When uncertainty touches a stock like this, sellers do not wait around to ask questions. But then, and this is the part that separates a broken stock from a coiled spring, look at what happened almost immediately after. A massive 9% product-driven reversal. The stock printed an intraday high of $5.80 before settling in around the $5.60 level. That was not random noise. That was not a short squeeze. That was buyers with conviction stepping in because of two very specific product launches. And to understand why those launches sparked that kind of demand, we have to look at the financial engine underneath this company. Here is the number the bears are refusing to look at. In Q1 2026, NIO posted revenue of 25.53 billion renminbi, roughly 3.7 billion US dollars. That is a 112.2% year-over-year increase. Let that sink in. They nearly doubled their revenue in a single year. Vehicle deliveries jumped 98.3%, reaching 83,465 units. But the number that genuinely stopped me cold when I first saw this is 18.8%. That is NIO's vehicle margin, and it marks a 4-year high in a sector where most competitors are actively losing money on every car they sell. In China's EV bloodbath, NIO just clocked a 4-year profitability peak. They also just posted their second consecutive quarter of positive adjusted operating profit at 66.8 million renminbi. Yes, there is still a GAAP net loss of 332 million renminbi. I am not hiding that, but that adjusted profit number tells us the core business model is finally beginning to scale in a way that actually matters, and those margins are not an accident. They are the direct result of a two-pronged product strategy that is simultaneously attacking the luxury tier and the mass market. On the premium end, NIO launched the flagship ES9 SUV, officially China's largest battery-electric SUV, and they pulled off a masterclass in launch psychology by pricing it starting at 498,000 renminbi, which, if you opt into their battery-as-a-service model, drops all the way down to 390,000 renminbi. That undercut their own pre-sale estimates by 30,000 renminbi, and the demand was immediate and overwhelming. We are talking about more than 50,000 pre-orders, with expected conversion rates exceeding 50%. Could those conversion rates come in well below expectations and completely undermine the Q2 delivery thesis? It would be an enormous shock to everything management has projected, but it is a risk worth naming because the bears absolutely will. On the mass market side, NIO rolled out the Onvo L60, their volume challenger, featuring a LiDAR upgrade powered by their own in-house 5nm chip, priced to go head-to-head with the Tesla Model Y for Chinese consumers. Two products, two completely different market segments, one coordinated strategy to own the entire domestic landscape. But none of this product momentum matters if the company burns through its capital before those cars reach consumers at scale. This is why the strategic decisions management made on capital expenditure are arguably more important than any individual product launch. NIO just executed what I would describe as a masterclass in balance sheet protection. First, they spun out their chip-making division into a new standalone entity called Genetech. NIO retains a 62.7% stake, so they keep the upside and the strategic alignment, but they are completely insulating their core balance sheet from the heavy, ongoing capital expenditure that semiconductor development demands. That is a clean, intelligent financial maneuver. Second, and this created real controversy, NIO enacted a geographical pivot by pausing all European operations and model updates until late 2027. Every resource that was being deployed internationally is being redirected into the domestic Chinese market. Does that hurt their European brand equity? Probably. Could that decision cost them a meaningful first-mover advantage in a market that could be critical 5 years from now? Possibly. But from a near-term survival and financial optimization standpoint, this is the right call. You consolidate, you dominate your home turf, and you expand again from a position of strength. Wall Street has noticed all of this, and the analyst upgrades are stacking up. HSBC just upgraded NIO to a buy rating with a price target of $6.80, citing strong conviction in their 2026 volume growth trajectory. CLSA upgraded from $6 all the way to a $7 target with an outperform rating on the H shares. Citi is maintaining their buy rating with the most aggressive target on the board. $8.20. Even Deutsche Bank, while holding their existing rating, increased their 2026 delivery projections by 5% up to 420,000 units, specifically because of the ES9 momentum. The consensus is cautiously sitting at hold around $6.70. But the direction of the upgrades is unmistakably upward. So who is actually owning this stock while everyone debates? Right now, there are 456 institutional owners collectively holding 280.17 million shares. We are talking about D.E. Shaw, Susquehanna, Morgan Stanley, and Renaissance Technologies, firms that do not accumulate positions based on hope. They operate on data and conviction. The fund sentiment score is high, meaning institutions are actively accumulating and building a support base concentrated around the $5 to $5.20 range. That is your floor. That is where the big money lives. But the bears have a real argument too, and we have to give it the respect it deserves. CEO William Li recently issued a stark warning that the Chinese auto sector has moved past its golden era and is now a saturated market. Add to that the regulatory uncertainty around Beijing's approach to cross-border trading, coordinated online reputational attacks targeting the brand, and the very real possibility of raw material cost inflation eating directly into those beautiful 18.8% margins. And you have a stock that deserves every ounce of caution investors are applying to it. Now, retail traders love to talk about short squeezes, so let me give you the actual data instead of the speculation. There are currently 137.51 million shares sold short, about 2.8 days to cover, with off-exchange short volume accounting for over half of all trading activity. That sounds alarming. But here is the paradox that completely dismantles the short squeeze narrative. The borrow fee rate is sitting at an almost non-existent 0.31 to 0.36%. In plain language, it is cheap, easy, and painless to short this stock right now. There is zero panic. There is no liquidity squeeze. An aggressive, violent, Reddit-style short squeeze is not coming this week. Trade accordingly. Technically, NIO is coiled in a classic consolidation squeeze. Back in April, the stock triggered a golden cross. The 50-day moving average crossed above the 200-day moving average, which is a structurally bullish signal. But right now, the price is pinned in a tug-of-war. On the downside, the 50-day and 100-day simple moving averages are converging to create a strong support zone between $5.47 and $5.49. On the upside, every rally attempt slams into resistance between $5.84 and $5.95, where the 20-day and 200-day SMAs are stacked like a wall. Momentum indicators are neutral. The RSI is at 54.14, and the MACD is flashing a weak, unconvincing buy signal. The spring is coiled. It is waiting for a catalyst to snap it in one direction, and that brings us to the hidden metric I teased at the very beginning of this video. For the June 5th expiration, the options chain is telling a very specific story. Call options are dominating, 81.41% of total options volume. Because of this heavy call positioning, market makers have constructed a massive call wall magnet at the $6 strike with nearly 16,679 open contracts. This acts like a gravitational pull, drawing the price upward, but it is also an incredibly hard ceiling because market makers will actively hedge against that level being breached. On the downside, there are put fortresses layered at the $5.50 strike. The conclusion is unavoidable. Market makers are engineering a pinning zone between $5.50 and $6. Their goal is to keep the stock in that range long enough for the maximum number of options contracts to expire completely worthless. The options chain is not a prediction, it is a roadmap. To actually escape this derivative trap, NIO's management has to execute flawlessly on two specific windows. In the next 30 to 90 days, the critical metrics are ES9 and Onvo L60 pre-order conversion into real recognized revenue and hitting their Q2 guidance target of 110,000 to 115,000 units. If those delivery numbers miss, the entire bull thesis stalls. Over the next 6 to 12 months, the existential risk is raw material cost inflation. Management has warned that copper and lithium price increases could add up to 10,000 renminbi per vehicle in costs. If that hits, it drags those margins from 18.8% back toward the 17% range. And the whole story changes. So here is your complete trade blueprint for the June 1st through 5th window. Direction: neutral to bullish. We are playing range-bound consolidation with a slight upside bias. Your optimal entry zone sits between $5.45 and $5.55, right at the convergence of the 50-day and 100-day moving averages, fortified by that heavy put-open interest floor. If the trade moves against you, your primary support is $5.47, and your hard psychological stop loss is the $5 mark. On the upside, primary resistance is the 200-day SMA ceiling between $5.84 and $5.99. Do not forget that $6 call wall. It will cap short-term rallies. For profit-taking, we have two scenarios. Target 1 is the short-term play, a take-profit zone of $5.85 to $6. Exit before the stock hits the institutional resistance of that $6 call wall. Take the base hit, secure the capital, do not get greedy. Target 2 is the medium-term breakout between $6.70 and $7, aligning with the CLSA and HSBC upgrades. But this target requires a sustained, high-volume breakout above the 200-day moving average and definitive proof in the Q2 earnings report that delivery scale has outpaced cash burn. Without both conditions, the $7 target is a wish, not a thesis. The final verdict on NIO is this: the fundamental turnaround is real. 112% revenue growth and 18.8% vehicle margins are not flukes. They are proof that NIO's premium positioning is working even inside China's brutal price war. But the technical restraint is equally real. A wall of macroeconomic uncertainty, cost inflation risk, and a carefully constructed options trap have locked this stock into a tight, manipulated range. For this week, do not be a hero. Exploit the range. Enter between $5.45 and $5.50, respect the $6 ceiling, and wait for Q2 delivery data before making any long-term conviction sizing decision. Trade the data, not the emotion, not the hype, not the fear. Before we wrap up, a quick but important note. Everything discussed in this video is strictly for educational and informational purposes only. Nothing here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. I am not a licensed financial advisor. Stock trading involves significant risk, and you can lose money. Always do your own research, and if needed, consult a qualified financial professional before making any investment decisions. Past performance is not indicative of future results. All right, Smart Stock Sam family. That is the full NIO breakdown for this week. Now I want to hear from you in the comments. Do you think NIO breaks above that $6 call wall before June 5th, or does the options pinning hold and we grind sideways all week? Drop your price prediction below. I read every single comment. If this analysis added value to your trading week, hit that like button right now. It takes 2 seconds, and it genuinely helps this channel reach more investors who need this kind of deep dive research. And if you are not subscribed yet, what are you doing? Hit subscribe and turn on the bell so you never miss an analysis like this one. And if you really want to support the work we do here at Smart Stock Sam and help us keep producing content like this, you can send a super thanks right here on YouTube. Every single contribution goes directly back into making better, deeper, more data-driven content for this community. Thank you for watching. Stay sharp, stay disciplined, and I will see you in the next one.